Hello there, traders and friends right around the world. It is James here with you on this Tuesday afternoon market recap. Obviously, yesterday being Monday, the US markets were closed in observance for the Labor Day public holiday. Today, however, we have seen quite an advancement higher across all three of the US indices. The Dow Jones Industrial Average today closed up just shy of over 400 points. It's making a very interesting type of chart pattern. This is what we call a wedge. Now, generally wedges resolve themselves in the underlying trend direction. If that is to be true, we are expecting, funnily enough, to see this market come back down and potentially retest these lows. It doesn't have to happen because this candlestick right here at the apex of this wedge is particularly bullish. I'm still waiting upon our final volume count at the moment. I'm only seeing the first lot of trading data flow into my trading software, but at the moment it does look as though we have a very good chance that this is going to be the rally which we've been expecting back up to about 17,000, even as high as about 17,500. Just a very interesting type of chart pattern I wanted to point out to you in this Tuesday afternoon market recap. Very similar type of chart pattern also playing out on the S&P 500. You can see the apex of this wedge. We are very close to it, and once we break out above the high of the wedge or even below the low of the wedge, we generally trade in that trend direction, the direction of the breakout. At the moment, however, volatility is especially high. We have gone through quite an impressive correction over the past 3 weeks. We are generally type of stabilizing right now. We are carving out what I put out in a video a couple of days ago, an intermediate bottom, and it does look as though once again we are going to come up anywhere between the 2000 all the way up to about the 2075 level on the S&P 500. We have to pay very close attention to both the 100 and the 200 simple moving averages on both these charts because we have seen that death cross on the Dow Jones Industrial Average. It hasn't happened yet on the S&P 500, but give it another week or so, if price does continue to trade around, this 2,000 to 1,950 area, even as low as 1,900, we just continue moving back and forth, we are going to see that death cross again on the S&P 500. That, of course, will act as resistance. Very, very strong resistance when, in fact, price has the strength and the determination at least to rally back up and retest these new resistance levels which have formed on the 100 and the 200 simple moving averages. On top of that, again, we are still paying very close attention to the declining exponential moving averages. Over the weekend, we were speaking about these declining exponential moving averages, and we started to say to ourselves that eventually this 10 is going to break. Now, at the moment, we have closed above the 10 exponential moving average. We haven't actually done this, so this is the first time since we had to go back to, what was the date up here, the 17th of August, where we got a definitive close above the 10 exponential moving average. In the past, even for the past 2 weeks, we've come back up and we failed to break above it, or at least see a legitimate close. On this one occasion dating back to Thursday last week, we poked our head up above it intraday, but you can see we sold off. It left us with a very interesting candlestick pattern. This is what we call an evening shooting star candlestick pattern. This is exceptionally bearish. However, today, again, on the Dow Jones Industrial Average, we closed up 390 points, and you can see the similarities once again. You get that evening star shooting star pattern, or the evening shooting star candlestick pattern, but we did today negate that pattern. We closed up very close to 50 points on the S&P 500. Moving into the NASDAQ, this is one of the markets which has been somewhat of an exception. The other two markets, the Dow Jones and the S&P, have been relatively bearish, but the NASDAQ has held up quite strong. We saw that very quick sell-off. We saw a very quick snapback. And instead of coming back down and more so moving into another 50% retracement of this second cycle right here, we're more or less back at the highs we were retesting dating back a week ago. So you can see we're very close to the 50 exponential moving average already. And we are still below the 100 and 200, but we aren't as close to that cross as what we are on the S&P 500. Again, we've seen that cross take place on the Dow Jones Industrial Average already. So the NASDAQ will be, again, first to any bullish rallies, and it will be last to any bearish corrections. So this is really the market, again, which we need to pay attention to. But in my opinion, my personal opinion, the Dow Jones Industrial Average encompasses the better part, or more so that of the US economy as a whole, instead of the NASDAQ. Some people like to trade or base their technical decisions off the S&P 500. I do believe the S&P 500, again, is more inclusive of the general US economy itself rather than the NASDAQ. But again, my go-to market is the Dow Jones Industrial Average. It displays great discipline and structure. And when we see these technical breakdowns or breakouts, generally the other two markets follow. So keep that in mind. In terms of our top 12 individual trade analysis, the only trade which we were in over the weekend was Netflix, and it was Netflix bearish. Funnily enough, In the face of such a monumental rally today, again, the Dow Jones up just below 400 points. Netflix closed down very close to $4. Our original trigger on this trade, 101.16 at the moment. We closed at $94.90. Over the weekend, we spoke about getting out of this trade if we did see any type of bearish continuation type of candle, and just be happy with the profit which we've made. If we call this a $100 entry and we call this a $94 exit, that's 6% in equity terms, which we've made on Netflix. If you put that through to put options, it's a lot more. So congratulations if you took the Netflix trade. Maybe you're still in it. But right now we are dancing all around that 100 simple moving average. Volume did expand today, so this is definitely a sell signal. It's whether or not you want to bank the profit or actually hold on to the trade. At the moment, your stop needs to go above Tuesday's candle. That's the absolute best which we can do as technical swing traders. I understand that that comes in at about 103, 102.50. So you need to ask yourself the question, is it worth having this trade on the table if we're trading all the way down at $94.90? For me personally, given that I expect volatility to continue in the market, and again, we're seeing these conflicting and bifurcated signals in terms of wedges and just all-round volatility with the markets gapping up a couple of hundred points or down a couple of hundred points, depending on which day of the week it is. You need to ask yourself the question, do I want to hold on to this trade as a swing trade or just simply leg out of it and put that money in my back pocket? I know which I'd be choosing of the two, and I just wanted to really clarify that. Outside of this one bearish trade on Netflix, we've had a lot of stocks. Really, our premise so far is to really just stay more or less out of any bull bounces, because it will be a shorting opportunity in the near-term future. A lot of these trades which we follow, Apple, Amazon, Boeing Airlines, Baidu, Caterpillar, CVX, Google, Goldman Sachs, IBM, Tesla, and Walgreens Boots and Alliance are beginning to bounce. They are bouncing into areas which we have highlighted on our charts where we want to see early reversal, candlestick reversals or terminal reversals, and then we're looking at shorting a lot of these stocks. Now, I'm not going to go into detail on this YouTube channel, but pay attention to these red boxes and make sure that it aligns with where the markets are trading at on the actual indices themselves. Pay attention to these red boxes on the Dow Jones Industrial Average. Pay attention to the red boxes on the S&P 500, and also pay attention, I think I have one on the NASDAQ. Yes, I do, because these are very, very important locations, is what we call pivot points, and really just areas on the chart where we expect the market to make the next big intermediate move. This has really been the first intermediate move. It still is in a correctional type of phase. We haven't sold off, or we haven't closed below, I think, 13%, especially not after today's bullish bounce back. But if this is a legitimate lower low and we are going to establish a new lower high, well, then the next wave lower is how you'd want to trade. This little bounce back into these declining exponential moving averages and also these simple moving averages isn't really the trade you want to be taking. This is what we call counter trend. Instead, you'd rather trade with the direction of the trend. And at the moment, if this is a legitimate reversal, the direction of the trend has shifted, and now we're moving into what could be very much a bear market. So pay attention to that. Doesn't mean that you need to make any decisions immediately right now. We're just simply following price action, and when the time is right, we will start initiating longer term trades on the overall market. So this is, again, the end of the Tuesday afternoon market recap. One final piece of homework or housekeeping, not homework, housekeeping definitely. I have a lot of emails in my inbox. I've been inundated. At the moment, it sits with over 100 in my inbox. I haven't been on top of my emails. Again, I've been unwell and I've been doing a lot of things away from the markets. I am going to endeavor right now to get through as many of those emails as possible. If I haven't replied to you or responded as quickly as which I generally do, I'm apologetic for that. My apologies. Again, I'm going to sit down over the next maybe 3 hours, 4 hours once I get this recording online and start responding to the majority of those emails. So my apologies if I haven't contacted you or responded to you. Again, I've been quite unwell and I've had a few other things going on, which has really sort of made me delay my responses to people. I'm not avoiding anyone whatsoever. It's really the same for everyone. So don't think or don't feel as though I'm avoiding your particular question and responding to anyone else's. This is just a broad type of just slow down in my response time. So I will get through those today, all right? Even if they are a little vague, or not so much vague, but if they're not as long as what they are or detailed, it's because I've got so many to respond to, all right? So I will leave it at that for this Tuesday afternoon market recap. Have a fantastic evening, everyone around the world. Again, patience is key. We'll cherry pick the right time to enter into this market, and we will be rewarded for that. Until then, I'll most likely be back with you tomorrow. We'll see what the market does. But again, today, 390 point update to start the week. Very nice. In terms of a weekly candle, you can see we've pretty much made back all of the losses which we started to sustain last week. So you can see how quickly these markets bounce, understanding that we are carving out an intermediate bottom, and the next move is back up to the red box, which should set up the next shorting opportunity. Anyway, everyone, have a fantastic Tuesday evening. I'll be back with you with another market recap later in the week. All the best. Goodbye.